Good afternoon. My name is Joseph Litchower, and thank you very much for all taking the time today to join us for this week's event, A New Era of Equity Income. Today, we'll be hearing from Richard Aston, the lead portfolio manager of CC Japan Income and Growth, ticker CCGI. And Richard boasts over 3 decades of experience in the industry, so is intimately familiar with the Japanese universe. Richard has been managing CCGI since it launched in December 2015 and pursues a strong emphasis on total returns, unlike many others in the sector, and considers both capital and income growth as 2 key components to the strategy. Before I hand over to Richard, I'll quickly run through a bit of a plan for today, just for those new to the format. Richard will present on the trust for around half an hour or so, and then we'll move on to Q&A, which will take about 10 to 15 minutes. So if you do have any burning questions that you want me to put to Richard, please just pop them into the Q&A box in the bottom right-hand side of your screen, and we'll get to them at the end of the presentation. So with that, Richard, it's my pleasure to welcome you. Please take it away.
Thanks very much, Joe, and thank you everyone for attending. To talk about a new era of income. The opportunity that we believe exists in Japan has actually been evident for quite a number of years, but can we just maybe look at the first slide, which looks at the equity market returns from Japan. And I think the starting point for most discussions I have is really based on the difficulties people had investing in Japan a decade or so ago. Many people are probably aware that the Nikkei finally surpassed its bubble era level earlier this year. To some extent, that's rather irrelevant, because if you look at Topics, which is a more representative index, you can see that actually the returns have exceeded the 89 peaks quite some time ago, and actually the overall returns from Japanese equities have been strong. Many people are locked in the mindset, say, of two or 3 decades ago, where Japan was only a place that you gave sort of cursory consideration to, and if you were lucky enough to capture strong market rallies, then you were able to generate a positive return. But actually, for many, and probably the right approach for a long period of time, was really just to have ignored Japan. However, we felt there was something very interesting taking place at the beginning, really following the financial crisis, and that was for 2 reasons. Firstly, there was a very, very notable derating of Japanese equities that was very evident in 2009, 2010. And we felt that was the final derating from the very, very lofty valuations that Japan had exhibited consistently since the bubble period. So for a long period of time, equities in Japan traded a very, very significant premium to the international peer group. Very, very difficult to justify. But that disappeared in 2009, 2010. So firstly, valuation. And then secondly, from a bottom-up perspective, the approach that we take has been very, very much bottom-up in the way that we look at Japan for a number of reasons. But from a bottom-up perspective, we were finding an interesting change in management mindset in the way that they were beginning to understand better the requirements of shareholders and their requirements really towards shareholders as custodians of the business. This was actually accelerated by the program of reform, as we now know as Abenomics. So under former Prime Minister Abe, Japan entered a period of reform and restructuring, and a very, very important component of that in the third arrow in particular was a focus on improving capital efficiency, improving corporate governance, as a consequence of that, improving shareholder return. And we feel that has been a very, very strong tailwind in the performance of the market, as you can see here. Maybe looking at it from a slightly different perspective on the next slide, where we look at the opportunity as we saw it and how we identified this. And these are the charts actually we've been using consistently since we established, because I think it demonstrates the story very, very well, and is a very, very powerful combination. The chart on the left-hand side is corporate cash flow. So the dark blue line is cash flow generated by corporates in Japan, and the light blue line is cash flow spent, or capex. And there's this extended period as Japan recovered during the 60s, 70s, 80s, even the 90s, where corporates in Japan were spending all of the cash flow that they generated. In fact, during the bubble, you can see that they were doing more than that. And it wasn't until after the Asian crisis and the tech crash, 99, 2000, that I think the problems from this extended period of overinvestment started to become apparent. At that stage, Japan started to experience a number of things that it hadn't done before. Corporate bankruptcies, non-performing loans. This resulted in nationalisation of the banking sector, changing attitudes to lending. From a corporate management standpoint, this resulted in companies beginning to pay down some of the debts that had accumulated over the previous decades. Companies were forced to write down their impaired assets, the assets that had been accumulated at inflated prices. And you can see the corporate mindset changed quite notably, because rather than the very tight correlation between those two lines, you can see that they subsequently started to diverge quite notably. But in addition to that write down or repairing of balance sheets, you can see from the chart on the right hand side, a portion of this now surplus cash flow started to come back to shareholders in the form of dividends and share buybacks. And that's really what attracted our attention, because we felt that it gave a rather different consideration for investors when looking at Japan, maybe looking for some of the components of return that they're able to seek or have been able to seek in other markets. And that's direct return to shareholders through dividends and share buybacks. As I mentioned, former Prime Minister Abe came to power in 2012, but he introduced Abenomics in 2013. And this has been a very, very significant tailwind to this improvement in corporate governance. And we've seen the benefit of that, both in terms of the improvement of capital efficiency. I would just highlight the strong return of that chart on the left-hand side, the cash flow generation component, but also with the improving corporate governance and a recognition of shareholders, in particular, the benefit that has generated, which we can see on the right-hand side, particularly in terms of dividend, but also in terms of share buybacks as well. Maybe looking at the next slide, where we start to look at the reasons for this, and actually reasons why we believe, even though it's been a topic that has been relevant and something we've been speaking about for quite an extended period, over 10 years, actually the opportunity is arguably greater now than it was even when we first launched in 2015. The foundations for what we've seen really come from corporate governance initiatives initially established through the Corporate Governance Code and the Stewardship Code, which are modelled very much on the ones we have here in the UK, that effectively created a very different environment for shareholders and corporate management to discuss issues or relevant issues in a way that they weren't able to do so before. Obviously, it seems quite incredible given the extensive experience we have operating in markets that are generally more efficient and where governance standards are historically have been much, much higher. But it was the case that the relationship and the understanding of corporate management of the role of shareholders was very, very different. That is changing, or has changed, and continues to change. So we've got an evolution here of some of the initiatives that have been introduced that further enhance this. Maybe I would highlight in particular the Tokyo Stock Exchange initiative that was announced at the beginning of 2023, to raise awareness of cost of capital and improve sort of corporate governance within the market. The particular focus there was the many companies that trade below book value that are listed in Japan. More than half of the market at that particular point in time traded at a price to book value of less than 1. And effectively, the Tokyo Stock Exchange, as an interested third party, we're looking to raise standards by saying that stocks or companies whose price to book value is less than 1 effectively are being told by the stock market or stock market participants that they're being run inefficiently, and that has to change. And we've seen a notable improvement, a number of very, very interesting dynamics within the market that we believe are a direct consequence of that particular push. But things continue to evolve. That is very much a driving force, but we've also seen additional initiatives. So in the last 12 months, maybe rules around sort of parent subsidiary relationships that have resulted in quite a sharp reduction in the number of dual listings or parent subsidiary listings in Japan. A particular focus in the insurance sector, resulting in an improvement order, basically encouraging, or more than encouraging, companies, forcing companies to sell down their cross shareholdings. Consideration that has been a headwind for the Japanese market for some period of time. Going through into 2025, we're expecting to see a further revision to the stewardship code, some amendments to some particular regulations around share ownership, particularly large shareholder ownership, and also further revisions to the Tokyo Stock Exchange reform that we first highlighted in 2022. This is actually creating an opportunity for a number of companies that don't feel that the tighter corporate governance standards are for them, and the number of companies are doing that, questioning why they're actually listed, is giving them the opportunity to effectively delist. And we're seeing a daily flow of sort of management buyouts or corporate takeovers that to such an extent that are at a level that we haven't seen before, all of which we think is very, very positive. So what is it that we identify? What is it we're looking for? On the next slide, as Joe mentioned at the beginning, total shareholder return is our focus. So even though some people sometimes look at the name of the strategy, income and growth, and wonder whether or not it's just a case of looking for a few income stocks and balancing that with growth stocks, the answer to that is no. I think we're in a fortunate position in Japan, arguably because many companies are coming from a lower starting point, but we are able to find companies that have all of the characteristics, so are able to generate growth and capital growth of the share price as a result of that, but are able to sort of complement that or support that with the compounding benefits of progressive return to shareholders through dividends and share buybacks. From our perspective, over the last 10 years, we have seen a very significant improvement, I think, in the general understanding of the role of shareholders. And as a consequence of that, we've seen a very sort of notable trend or notable trends emerge within the market. Certainly, if I think back to 10, 15 years ago, many companies were quite uncertain as to what this new era would mean, what we as shareholders, what I might mean as a shareholder, or what my requirements might be as a shareholder. And there was some period of education or re-education. But it's very, very clear now that companies are demonstrating much clearer strategies for growth and capital efficiency. The growth discussion is very interesting given some of the underlying dynamics within Japan. Obviously, an exit from deflation, nominal GDP growth. These are very, very different considerations for the economy and corporate managers from where we've been for the last sort of 15 or 20 years. But particularly on capital efficiency, companies, when we meet them face to face, have a number of slides now talking about their response to the Tokyo Stock Exchange initiatives and improving capital efficiency and the benefits of that. Over time, we've seen a very definite emphasis on dividends over share buybacks. Going back 10 years, as I mentioned, there was someone, I think companies were seeking clarity, but I think ultimately the focus on dividends has come to the fore because that satisfies the requirements better for a lot of the domestic investors that are still very, very significant shareholders. Very, very importantly, there's a much, much greater emphasis on stability of dividends rather than up here an explicit payout ratio. If I go back as far as say 2005, 2006, where the previous chart shows that this more favourable trend towards shareholders emerged, most companies would focus on a specific payout ratio, meaning each and every year they'd pay out a particular percentage to their shareholders based on what they'd earned in that particular year. I think the problems that creates were very, very clear during the financial crisis when earnings started to fall. Companies, maybe to their credit, did apply that payout ratio in a very disciplined manner, but because earnings were falling, it meant that sort of dividend payouts or dividend payments were falling. And that proved very, very unsatisfactory to the majority of investors, say particularly domestic investors. So as a result of that, a sort of new word or a new focus emerged in the years that followed, with a much, much greater emphasis on stability of dividend over time and the intent to grow it progressively, generate the compounding benefits that generally investors are much more familiar with. The other interesting trend, I think, is a much, much greater divergence now between the way that companies are looking to pay out. So different sectors have different sort of capital requirements, and whereas 10 years or so ago, that didn't cause any differentiation between how they approach their returns to, or approach their strategies for returns to shareholders. So payout ratios effectively were the same regardless of capital requirements. Actually, I think because of the greater focus on capital efficiency, we're now seeing a greater divergence between payout targets and shareholder return strategies between different sectors. And finally, companies are taking a rather pragmatic approach to buybacks, giving considerations to factors such as market valuation and also liquidity events. So we feel that's the most appropriate way for companies to utilize their ability to buy back shares. Maybe looking at the next slide, please. Thank you. Again, just reiterating what it is that we are looking for. We are looking for established growth companies, and I think Japan, maybe because of them, its history has a lot of companies that we would call established growth companies. So companies that have been around for a long period of time, companies that have demonstrated competitiveness and growth characteristics, and that these companies are in a strong position to grow going forward. Very importantly, they have the finances to continue to reap the benefits of those growth opportunities. So it's very, very important with any companies that we speak to, any companies that we invest in, that they prioritize growth, long-term growth. We're looking to invest in companies that have the financial capability to be able to do that, either from their general cash flow characteristics or the strength of their balance sheet. But very, very importantly, we are looking for companies where management are aligned with our objectives of improving returns consistently over time. Obviously, if we can identify companies that have done that consistently over the last few years, that gives us greater confidence going forward. But Japan at the moment is going through this fairly significant corporate governance change. And as a result of that, we are looking for companies where that change can have very, very significant benefit to us as shareholders as well. To give a sense of what we identify within the portfolio, so rather than say Japan is good at this sector or good at this in this industry, etc., I think we rather look at it in a slightly different way. We are aware that there are some dynamics within Japan that maybe from a much higher level might put people off. The demographic profile, for example, is well known, the aging population. But that aging population is something that the Japanese government have been very, very good at telling the general population, at telling the corporate world for quite a good period of time. I first started covering Japanese equities in 1997, and I think on day one, it was drummed into me that the Japanese population was likely to peak. In reality, it didn't peak until around about 2012, 2013. So that's given companies a very, very long time to address the problems that might create going forward. And as a result of that, there are quite a number of companies whose focus has been beyond the shores of Japan for quite a considerable time. Many of these companies have established themselves as strong global players. Highlight maybe two companies to begin with on the right-hand side: Tokyo Electron and Shin-Etsu Chemical. Despite the fact that Japan did lose competitiveness in areas such as consumer electronics and maybe semiconductors during the 80s and 90s, there are areas where actually it continue to enhance its position. And companies like Shin-Etsu and Tokyo Electron, which are both companies involved in the production of semiconductors. You have two examples there of companies that have enhanced their global position, their global reputation over that time frame. Shin-Etsu Chemical is the world's largest manufacturer of silicon wafer. It's also the world's leading producer of PVC and a number of other key products. Arguably, this is something that could well be debated, but I think it's probably one of the strongest, if not the strongest, chemical company in the world. It certainly has the highest margins. It has been investing significantly over the last 20 years in overseas markets. Although interestingly enough, its most recent investment has actually been in Japan. It's made its first major investment in Japan for over 25 years. That ties in with maybe another topic, another reason to maybe look at Japan again, and that's to do with economic security and rebuilding of supply chains. And Japan is looking to maybe regain some of the prominence it had in areas of like semiconductor production, and there's some very, very significant investment now being made within Japan for the first time in a number of years. And Tokyo Electron is a leading manufacturer of semiconductor production equipment. Again, a key beneficiary of some of the investment we're now seeing, not just domestically, but also internationally. Shoei is a slightly different example. Shoei is the world's leading manufacturer of premium motorcycle helmets. It's a company that has two domestic factories, but exports to over 90 countries around the world. So to all intents and purposes, its 3% revenues it generates from Japan don't really define the performance of that business. There are many opportunities within the region for companies that are based in Japan. Certainly, even though the domestic population is aging, right on their doorstep are economies where the population is growing rapidly, and the age dynamics are very, very different. So it may be a younger, faster growing consumer base, which many companies feel will generate significant opportunity for them going forward. And despite, and I would say, what one thing that I think Japanese companies are well recognized for in and around the region is product quality and product service. So Japanese companies have this very, very high reputation for product quality and product service, and companies are able to utilize that to establish themselves as strong players within the region. Within the examples here, we have sort of financial services. So Sumitomo Mitsui Financial, especially UFJ Financial, are large financial holding companies incorporating banking businesses, banking services, asset management, securities, leasing, etc., consumer finance, and they're utilizing their strong reputation within Japan to establish themselves in and around the region. SBI Holdings is also a strong financial player within Japan. Areas such as cosmetics and healthcare are also very, very important. Novia is one of Japan's leading skincare brands. In fact, it has 2 of the top performing skincare brands, and it's been able to utilize that maybe recognition that has come as Japan has opened itself up to more tourists, and recognition that has given a lot of these domestic companies to expand further across the Asian region. Mani is a healthcare company, and again, the dynamics there are very, very similar. In a company that's established itself, has been established for very many years as a leading domestic player. Mani produces a number of healthcare related products, really just from a core technology, which is high precision manufacture. It manufactures medical sutures, so that's for stitching. It manufactures knives for high precision knives for ophthalmic treatments, and also dental equipment, so files and drills, really with this high precision manufacturing technology. It's established a very, very strong, over many years, strong position in the domestic market. It's replicated that in China, and is currently doing the same, growing at very, very rapid rates in places like India. So we see some very, very significant potential for growth there. We don't give up on the domestic market. The changing population dynamics do create individual opportunities. I'll just highlight the first 2 of those, DIP and Zozo, which are both businesses that operate online. It's an interesting fact that despite the fact that Japan generally is considered to be very, very advanced technologically in areas, I think things like e-commerce penetration are still very, very low in comparison to Western averages, and also some much higher levels of penetration in economies much, much closer to Japan, such as Korea. And companies like DIP and Zozo, which are based entirely online, we believe continue to exhibit very significant growth potential. DIP is leading online job recruitment company. Zozo is leading online fashion retailing. If we could move to the next slide, just really that we incorporate these just to highlight the fact that, as I mentioned earlier, despite the fact this has been a very important driver for the equity market over the last 10 years, we feel that the opportunity is still extremely exciting, still extremely relevant, and in many ways, actually, the opportunity now is greater than it was when we first launched. Certainly, in terms of the potential, we can highlight that with the data here. For example, the number of companies with surplus cash on their balance sheet has continued to increase. So even though companies have been in aggregate very generous, as the earlier slides or the earlier chart shows, with their distributions both through dividends and share buybacks, actually if you look at the amount of companies or the number of companies with net cash on their balance sheet, that has increased. The aggregate amount of cash held on corporate balance sheets has also continued to increase. So actually the potential for companies to continue to distribute to shareholders has increased quite notably. Looking at this on the right hand side, you can see that despite this improvement, also we are seeing a general and steady increase in the aggregate amount of payout, but actually it's still very, very low in comparison to the international peer group. The benefit of that we saw very, very clearly during the COVID pandemic. So if you look at the amount of dividend cuts or the number of companies that cut their dividend in Japan during that time frame, it was very, very low in comparison to other markets, particularly the UK and Europe, because the dividend cover, which is the inverse of the payout ratio, was very, very high. So we feel potential for things to continue to improve is very, very clear. And very importantly, we are now combining that, or we see that running alongside a greater willingness of companies to conform to the standards that the likes of the TSE are now looking to introduce into Japan. So both the ability of companies to continue this and the willingness of them to do so is is very, very significant, and I think is much greater than it was when we first launched. So I think maybe that's just to the half an hour. I think that's right, Joe. So more than willing to
Richard on the dot. But no, thank you very much for going over that update on Japan, and I think it's very clear from your slides and from your insights that there is a lot going on at the minute. And seemingly with the current slide that's on the screen, I think it might be a good place to start there. I think it's pretty safe to say in decades past, investors wouldn't have flocked immediately to Japan for income. But that's obviously changing. The story is changing. And do you think that the interests that are peaking now are solely driven because of these reforms that are encouraging managers to better utilize that cash on balance sheets? Or do you think there are other underlying supporting factors there that are helping? And perhaps for the sake of the listeners, it might be worth pulling in an example in the portfolio where dividends or buybacks have increased over the last 12 to 24 months.
Yeah, I mean, certainly there are a lot of very, very exciting things going on in Japan. I mentioned from an economic standpoint, the exit from deflation creates a very, very different environment for companies. They can start to raise prices in a way that they haven't done for 20 years. For individuals that are beginning to see wages rise for the first time in 30 years. From the economy as a whole, we're seeing sort of positive GDP growth. It tends to be very, very positive for asset prices. And then from a bottom-up perspective, we are seeing this greater emphasis on asset utilization, greater emphasis on capital allocation, greater emphasis on corporate governance. All of which I think create a very, very sort of positive environment for investing in Japan. So quite often I'm asked about, well, what's the catalyst? But actually, unlike the previous decades, certainly between the bubble and when things bottomed, the financial crisis, I just don't think there's any need really to sort of focus on a catalyst as such. I think what we're seeing is very, very fundamental change that makes Japan market a region that you can look at to genuinely invest, buy and hold. So very, very different from where we were 10, 20 years ago. So it really is based around these sort of continual improvements. That's the reason to be looking at Japan. Having said that, we've seen some volatility in the market over the last 2 or 3 months, which I think maybe just creates a shorter term opportunity if anyone is looking to time things very, very precisely. But the long-term trend is very, very clear, I think, from the first chart we showed, the recent history, or probably slightly longer than just recent, but 30-year history of the Japanese equity market. You can see that there's a very, very notable change in the performance profile, and I think that is driven ultimately by these underlying drivers and the improvement in shareholder return.
And I appreciate the process that you're employing is bottom up, and we'll come quickly onto the trust shortly. But a couple from a political standpoint. Japanese elections, politics tend to fall relatively under the radar. They're not as flamboyant as those in the US, perhaps, but it would be great to get your thoughts on the upheaval after the snap election recently, and perhaps given the the noise around the US election, your thoughts on tariffs, because we know that Japan has strong relationships with the US and they play quite a critical role in the semiconductor space. So perhaps they might be more shielded than others in Asia, but it will be still good to get your thoughts on that, Richard.
Yeah, thank you, Joe. Yeah, I mean, Japanese politics are very, very interesting, certainly in comparison to other markets or other countries. Japan tends not to get the same level of or the same huge shifts that we've certainly experienced in Western economies in recent times. If you look back at the history of the political arena in Japan since the Second World War, it's effectively the same party in power consistently, with the exception of two very, very short periods. So it really is, it offers a degree of consistency that we haven't seen elsewhere. And I think that ultimately is a positive. It's and even though, if you highlight, there has been a change of prime minister in Japan, if you look at the underlying policies, they're still very, very consistent with even the policies that former Prime Minister Abe championed 10, 15 years ago. Subsequent prime ministers have added interesting policies on top of that, all of which really continue this this recovery of Japan as an economy from the deflationary period. So in terms of where we are now, we don't feel as if there's any significant different consideration for investors than there were sort of 3 or 4 months ago. If you look at sort of fundamental outlook and fundamental policies, then actually they're still very, very similar to what they were. If anything, actually it's slightly better, particularly in the short term, because part of the process of regaining power has meant that the current Prime Minister has focused a little bit more on short-term economic performance. And there's been a fairly large supplementary spending package announced, which we think will have a short-term benefit for the economy. But generally, the political environment has very little impact on the economic trend and the underlying trend that we feel is driving the equity market. Tariffs is obviously a very, very interesting topic. I think that from a top-down perspective, I think the long relationship that Japan has with the US probably positions it very well, or certainly better than many others with regard to the immediate future. And certainly we've seen it in terms of the short-term discussion on tariffs in particular, where they will fall. There's no particular focus on Japan. And I think, we think back to the first Trump presidency, 2016, there was a lot of talk of tariffs at that particular point and how that would impact Japan. The dynamics of exports from Japan are themselves quite interesting. They've changed quite notably since the 80s. The majority of exports from Japan are now auto sector related, so either auto or machineries, or machinery that's related to the auto sector. And as we saw in 2016, that's quite a difficult area for the US to impose. It proved to be quite a difficult area for the US to impose tariffs on Japan, because if you look at that subsequent period through from the 80s, actually the Japanese auto companies have been huge investors in production facilities in the US. And particularly in Republican states. So politically, it proved to be very, very difficult. And also the companies were also able very, very rapidly to adjust their production in a manner that meant that they could minimize the export component anyway. So if the tariffs were there to improve or change finances, then actually it didn't work because the Japanese companies were able to respond to that. So I think having learned from that, we don't feel that Japan will be affected dramatically by direct tariffs. Obviously, if there's a global slowdown, and particularly in areas like or regions like China, then there will undoubtedly be an indirect impact onto Japan, or a secondary impact on Japan from tariffs. But in terms of the direct impact, we don't feel that the risk is particularly significant.
Okay, fantastic. Thank you, Richard. I think steering back to the trust now, I think it'd be really good. I'm going to throw another two-parter at you. It'd be really good if we can go through a little bit more why you feel that placing such an emphasis on capital and income growth in Japan is an effective strategy, particularly, it's such a differentiated strategy from those in the peer group. And second, there is often quite a lot of conversation around adding value in a market like Japan. So what do you feel are the advantages for you as an active manager for a trust like CCGI and the differentiated approach that you employ?
Okay, great, thank you. Yeah, we feel that this is, we were in a position to offer a differentiated product because we were starting from afresh initially, and we launched an open-ended version in 2013. We weren't tied to any historic investment process. Investment processes that were maybe created during a very, very different period of investment opportunity within Japan. We were able to create something that we felt was appropriate for the market as it was and how we felt it was evolving. And with this improvement in corporate governance, we felt in particular that offering a product that was able to generate income as part of total return was particularly appropriate, because there was no focus elsewhere in the market on that. And I think the performance of the market and the performance of the trust, I think, really sort of demonstrate the benefit of doing that. The focus that we have, I think, is very, very important, and this really comes to the second part of the question, because Japan, or Japanese equity market, despite some of the improvements we've seen, is still a very, very inefficient equity market, and that's really what investors are looking to benefit from: inefficiencies. It's inefficient because management approach is still very, very inefficient. Hence the need for the Tokyo Stock Exchange initiatives. It's still quite easy to differentiate between the companies that are moving in the right direction or have delivered, or are moving in the right direction, and those that aren't. And maybe in some cases there are some reasons why companies won't move in that direction. And the market is inefficient because the information is inefficient. More than half the listed companies in Japan have no coverage at all from sell side, and a very good number above that maybe have very, very minimal or cursory coverage. So actually the information opportunity is very, very significant, and that's where we really come in as investment managers, sifting through all of these opportunities and identifying the best of those. We run a relatively concentrated portfolio, maximum of 40 holdings. Given that the number of listed stocks is over 4,000, you can see that how concentrated we are. But we think that continues to be relevant, given these given the opportunity really that these inefficiencies I've identified continue to exist.
Brilliant. Just a couple more questions, which are conscious of time. The first being, how do you and the team handle foreign exchange risk?
Foreign exchange is definitely a consideration. Although I'd point out, if you look at the that chart of the performance of the market, it has performed well throughout different phases of the economic cycle, during different periods of yen weakness, yen strength. That's both in terms of sort of constant currency, or local currency, or constant currency. So in terms of considering the opportunity in Japan, I don't think it's as relevant as it might have been 10, 15, 20 years ago. But in terms of what we are looking at. Obviously, we're very aware that individual companies do have different exposures to currency. Very, very difficult to quantify in each and every case, given that hedging policies, etc., are usually not disclosed. But our consideration at the moment is really based on our expectation that over time, the yen will strengthen. That's based on particular consideration of the interest rate or monetary policy environment in Japan compared to overseas. And that is a factor that we take into consideration with individual analysis of companies.
Brilliant. And within the portfolio itself, then, with CCGI's portfolio, you also invest across the market spectrum. So the smaller companies in the Japanese market as well, so the smaller mid caps. Now, the general view is that a lot of the large caps are seeing those immediate benefits from the corporate governance reforms that you've spoken in depth on already. But are you, as a manager who frequents Japan quite a bit, starting to see these improvements trickle down the cap scale as well?
Yeah, absolutely. I think there are two reasons really why we are seeing an increased appeal of small cap. Firstly, is valuation. We've seen a very, very significant derating. Having seen a very significant re-rating generally of small cap in the period, maybe 2017 to early 2020. We've, in the years that have followed, small cap has been substantially derated to sort of down towards historically low levels, and that has created a lot of interest in that particular segment of the market. But also, where this is now accompanied by this sort of trickling down of improvement of corporate governance, I think given the strategy we focus on and the opportunity set that we look for, we are seeing increased or broadening of investment candidates, I think, in that segment of the market.
Fantastic. Brilliant, Richard. Thank you so much for that. I think that's been a really good update on Japan and some really interesting answers to those questions from the audience as well. It does look like we've come to the end of our time for the webinar. So for those listeners still on with us, if you want any further information regarding CCGI, we at Kepler published a note early this month, so you can go onto the website and check that out. Richard and the team also put up a load of quality information on the trust, but also insights on the market itself as well, and that's the Shikara website. So with that, Richard, a really big thank you to you for joining. I think it's been a really good update and great to have you on.
Great. Well, thank you very much, Joe, and thank you everyone for listening in.
And again, I'll echo that. Extend our thanks to those that have joined today, and we hope to see you on tomorrow's webinar. Thank you very much for now. Take care. Bye-bye.